All right, welcome back, everybody. Road to Retirement, Brookside Financial Group, Tony Marlette Jr., Brookside with Tony Shore over at Gradient. Good morning, Tony.
Well, good morning, Tony, to you. It's a great morning. Good to be here with you
Of course.
and good to do the show with you again. I did a couple with Chris, and I know you've been really busy and you've been out. Your family moved. So hopefully it was a good move. You're moving on up.
Moving on up,
Yep.
right? Is that how it
Right.
goes?
That's how it
Something like
goes.
that?
Yeah, exactly.
I
Exactly.
won't sing anymore, I promise.
Please.
As always, just want to throw out there, you can book an appointment with us, obviously online. You can give us a call, visit us on the socials as well. We'll show those again at the end of the podcast as well. But I kind of wanted to take a look today, Tony, at a lot of people will ask us, during an initial appointment or during a review, where are we as an economy, as a country? Where are we as far as, you know, uh, it's a very confounding time. The markets really, there's not a lot of data supporting all of this. Frankly, the market's been fantastic this year.
Yeah.
Uh, a lot of times there's just not a lot of data to support that. But the facts are, the markets have been hovering around the 20% mark all year, which is welcome news for a lot of people, of course. So
Yeah.
when people want to know where you're at or what you anticipate, I think it helps to understand a little bit of the business cycle stages. So I thought we could take it back to Economics 101 and just kind of go over a few things as far as where we are, put it in context, a couple of things, why we're seeing some success, and maybe why in the future we can either expect to see some of these things or not so much.
Yeah, and I think it is we live in interesting times, right? That's what they say because things change and some things stay the same, but we have seen some interesting economic indicators out there, and that's why there's a lot of debate about where we're headed. We can learn some things by looking back, but where we're currently at has some people concerned, although this year the markets have been great. I mean, unemployment is still okay. Our
Hmm.
unemployment numbers, as far as
Hmm.
our economic landscape, but there are other indicators and concerns out there. I mean, we are on the cusp of another presidential election, and that usually causes some turmoil
Hmm.
in the markets a little bit, some hiccups, and then internationally, there's a lot going on. So we have rising healthcare costs. Inflation really did a number on folks last year. So I know a lot of people have a lot of these concerns.
Yeah. I mean, inflation, you nailed it. Inflation is really just it's been the headline for the past two plus years now. So it's hard to believe, for the first stage of the business cycle is known as expansion. It's hard to believe to me that, I mean, you could make an argument that we are still in an expansion if you just look at data. And what an expansion means really is just that GDP, which is gross domestic product, it's a total dollar amount of all the goods that are made in the United States every year. Gross
Right.
domestic product, or GDP, is growing and profits are strong. That usually indicates an expansion. An expansion comes, if you think of a hill, towards the beginning of the upward climb. That's why I say it's amazing to me that technically right now GDP is growing, it is increasing, and profits are strong. So definition wise, this fits an expansion. Although we hit this, I think we really hit the expansion if you think of it when we first started to come out of the pandemic a few years ago. I think that was really the beginning of the expansion. And even if some of the pandemic stuff was self-inflicted, I think when you have an expansion as quick as we did and as pronounced as we did, it points more to the fact that maybe this never should have happened in the first place. Um, we do a separate we did a separate podcast on that a while ago. But as far as this being the beginning of a positive business cycle. I don't believe that's the case, and I don't think that our friends over at Gradient, who we got some of this data from, believe that to be the case either. But theoretically, it's amazing to me how corporate profits are strong despite the fact that earnings are strong and interest rates have been rising, which is designed to have the opposite effect.
Yeah. Yeah, and that's true. And so, it is interesting. Everybody's talking about what is the Fed going to do? Are they going to keep raising interest rates, and how will that affect us? And I've heard a lot of people say they think they are going to keep raising them.
Oh yeah.
And they've given an indicator that they might keep doing that, which is interesting. I think that concerns some people because that does affect a lot of things when they raise the interest rates. I mean, home buying, the housing market is another thing that's hugely affected by that,
Yes.
right?
Absolutely. Absolutely. Everything is. And as far as the rates and what what the projection is, yeah, I do think it is widely expected that we're in for at least one more rate increase this year. So I know we have the symposium, the Fed symposium this week up in Wyoming. I don't know if we're going to get a rate hike, but it's certainly on the table. Maybe not this time, but I think next time.
Yeah. Yeah, I wouldn't be surprised if we get one or two more, and
Yeah.
I wouldn't be surprised if they do it again this time, because I think, they aren't down to the 2 yet, and they saw it maybe tick up slightly after the pause. So I think
Mhm.
they might keep
Okay.
going. I don't
Yeah,
know.
I mean, it certainly wouldn't be a surprise if they did. I just think that no matter what they do, if earnings are still strong, and Fed really regulates two things. It's just monetary policy and directly, indirectly, the employment picture. So if unemployment, as you mentioned, is in pretty decent shape, the numbers are looking good anyway. They kind of want the unemployment number to be a little high. As harsh as that sounds, if you slow down employment or you ramp up unemployment, then you slow down spending.
Yeah. Yeah, that's true. You do. And so it's interesting. I know that you have, you try to keep your thumb on this, or your eye on the ball, and what's going on. And I appreciate you and Chris staying on top of these things, so okay, here's where it's going. Here's what's happening. Here's where you're at personally. So here's where you should be with your assets, and you're actively managing those assets for your clients. Correct?
Right. Yeah, absolutely. And we always recommend, no matter what, we'll throw this in at the end usually, but it's a diversified approach that we recommend taking. You don't want to invest for what's going on now. You want to invest for, your overall picture and your overall goals and objectives.
Yeah.
We somewhat have an overheating economy, and when you near a high point, this is a second part of the business cycle, which is known as a peak. So we could be at a peak right now. We could even be a little bit on the way down. Um, Although, again, you wouldn't know it just based on the way the market has been performing. If I had to pick, I think one part of where we are right now, I guess this would be probably where I would say we are with, it's hard to say even that things are overheating at this point because spending is still strong. Consumer has become a little weak with inflation eroding away at everything. Again, with interest rates, like you mentioned, it's housing starts are down a little bit too. So the best may be behind us as far as spending and all that goes, but we're still really not seeing any sort of slowdown effect with any of this, and it's amazing.
Yeah, it is. It is amazing how, what's the word I'm looking for? The resilient the American
Yeah,
economy is, right?
absolutely.
To a lot of tumultuous events. You have a year like 2022 where not only are stocks down, not only did the market tank in 2022, bonds tanked. interest rates rose, and inflation was out of control. And still, the job market's looking good. And the companies, companies are strong. I mean, we saw a bit of layoffs in the tech world. Yeah, I think we saw some adjustments, right? I mean, it's basically, I think people panicked and talked about recession, but I think, maybe it had risen and risen and risen for a few years
Right.
since 2008. And so then I think they're just adjustments. I think some of those companies just overhired, and COVID leveled things out a little bit and changed things. So I think the economy, certain aspects of the markets and things, still are recovering from that. And I think, we're finally entering a stage where maybe, next year is going to be even better. I don't know. I'm hoping,
Yeah.
right? Nobody
Yeah,
has a
no, you're
crystal
right.
ball.
All right. Employment has been a major, we talk about headwinds and tailwinds. Employment or unemployment, either way, has been a major tailwind. So the wind's at your back, you have some momentum. But at the same time, I'm with you where, we have seen some big companies lay off a significant percentage of their workforce, mainly in the tech sector, like you said. And then as far as the recession goes, I think we were in a recession the second or third quarter of 2022. Now, a recession is technically defined, and I realize definitions need context, but a recession is defined as 2 consecutive quarters of negative GDP. Now, we had that in 2022, and now I think there's a lot of economists that are saying, well, you know what? We've had the GDP is increasing now, so we're nowhere near a recession. But these were the same people back then, including some people at Gradient, and I'm not sure why this happened, but you have the 2 negative quarters of GDP, and people say, well, no, there's no recession. You can't just use a definition, but at the same time, coming back now and saying, well, look at GDP, it's great. We're definitely nowhere near a recession. So to me, it's like, you live by the definition, you die by the definition. Like a
Yeah.
baseball team, like the Yankees or the Dodgers. You live by the home run, you die by the home run. So if you're not hitting
Right.
home
Right.
runs, you're not winning games. So to me, if we were in a quick recession back in 2022, we got out of it, and I would say right now the chances of a recession in 2023 are probably unlikely, but not to be taken off the table maybe in the first quarter of 2024.
Oh, okay. Interesting. Yeah, I mean, I keep hearing, we're still headed for a recession. So that's interesting. And I'm glad you guys are watching that once again. And I think it just illustrates why we need to work with a financial advisor, trusted financial professionals like yourselves, to make sure that our assets are properly allocated, that money we've been putting away for retirement, whether it's a 401k, an IRA, a savings account. We need to make sure that money is working properly for us. And as we get older, we don't want all of it at risk. So I'm glad you guys are on top of that. And that's what you do for your clients. And we have some great listeners out there. I know you love to hear from them. But they should probably get a second opinion on where they're at on their plan. If they don't have a plan, a financial plan or a retirement income plan set up yet, they need to get one. And now is the time, right?
Yeah, I mean, absolutely. We're fortunate to have the partnership that we do with Gradient. They do a great job with managing the portfolios and doing all the analysis and, making us look good, frankly. So we're glad to have the partnership with them. And we don't just do the, kind of the cookie cutter approach where everybody gets the same ETFs, everybody gets the same stocks. We customize these, and we have so many different directions that we can go in. We've done podcasts before about how we protect assets too, instead of doing the old, 60-40 stock bond approach. So really, you're right. You nailed it. It's not just about, asset allocation. Asset allocation has become somewhat commoditized. We're fortunate to have the partnerships that we do.
Yeah. Yeah, I think that's great. And I know you and Chris work hard for your clients to make sure that they know what's going on out there. And I like it because you guys worry about this stuff, so I don't have to.
Yeah,
Right?
yeah. No,
That's the
that's just
key,
it, and
isn't it?
that's part of it. That's part of what I
Yeah.
tell people. Part of our job is to save you from yourself. We don't
Right.
want you going and like, "Oh gosh, the market's dropping, time for me to abandon and jump ship," or "Market's going up, time for me to get back in." Uh, Again, that's really not the way that we do things.
Let
So
you guys manage those business cycle stages and watch those.
that's right. Yeah. So if we're
Yeah.
looking at where another part of kind of where we could be between a peak and what's known as a contraction, where GDP and earnings are in a decline. We mentioned before, we're not in a contraction right now because GDP and earnings are not in a decline, but really from where we're at, you have nowhere to go besides the next step would be the contraction. And this is where we usually find ourselves with the recession. So that very well could happen. You mentioned the possibility of that in the future. I know there are some economists out there predicting it later this year. I think that's been the talk all year long. But again, the bottom is just destined to fall out at some point. And I think once that happens, it is going to be the slowing down in spending and the further weakening of the consumer that's going to get us there.
Interesting. Well, we'll have to watch that. But it's not one of those. I know that you and Chris are very careful about not buying into the hype or contributing to the hype that, hey, the sky is falling, we're headed for disaster. That doesn't help anyone. Might there be a recession? Sure. But we have recessions. I mean, we
Right.
had one in 2000, again in 2008. These things happen. The Great Recession of 2008. I think people are more aware and trying to actively manage the situation, like the Fed and the government this time, possibly.
Mhm.
So hopefully it won't be as big of an impact as 2008 was when
Right.
we had that recession. But and maybe we can avoid it altogether. I know the Fed's trying really hard to bring us in a soft landing and get interest rates down, right?
Yeah.
Or the
Yeah.
inflation rate, I should say. I'm sorry,
Right.
the
Yeah. No,
inflation
you're
rate.
right. I
Yeah.
knew what you meant. Absolutely. I think that we're trying to do that, and we're trying to avoid what's known as a trough, which is the last stage, which is a sharp decline, basically a low point. And this would
Uh,
be what would you refer to as a soft landing. This would kind of be a hard landing. So you're right. We're
right.
trying to avoid a hard landing. And I think the Fed was late to react to everything, but at the same time, if they don't have to be as the word is hawkish, meaning, aggressive. They don't have to be as aggressive maybe going forward since we've had what 10, 11 hikes at this point. Uh, you pull the lever and be any more aggressive, we very well could end up at a low point.
Yeah. Yeah, that's true. We want to avoid that trough,
Right.
right?
Yeah, correct.
Yeah. Yeah, that's the business cycle stage that we like to avoid. So, how do you sum all this up? What do our listeners need to do?
Well, first of all, if you want to have your portfolio reviewed, if you reference this podcast, if you're an existing client of ours, either or, your initial consultation with us will cost you nothing. You can look at it, check out our website online, look at us on Facebook, YouTube video. YouTube videos will actually have some how-tos, different ways things work, and on our website on the on-demand page, you can take a look at previous market updates, previous podcasts that we've done. Call us out. Say, hey, you know what? You were wrong about this. You were wrong about that. That's fine. I like when people do that. We have people that come in that say, wait a minute, we were never in a recession. What are you talking about? As our video is playing in the lobby. So it's like it's kind of cool to see that engagement with people between us and our clients. But like you mentioned, we do the overall allocation, we do the planning for our clients. We take that off of your mind so you can focus on what really matters to you. Let us do the work, And, when we take a look at everything, we use a whole financial planning, a holistic approach to get that done. And again, we have great partnerships with Gradient and so many other companies to help us out with that.
Yeah. Yeah, that's great. Well, yeah, give that number again, read it aloud for our listeners out there in case they want to set up that no cost, no obligation consultation.
Yep. The phone number is 440-886-3550. And our website is brooksidetax.com. And you can check us out on YouTube and on Facebook, both at Brookside Financial.
Well, I'll tell you what, a great show today, Tony. Looking at where we're at right now, where we might be headed. And that's important to figure out, hey, where exactly are we at? What stage are we in and where we might be headed? Looking at some of those different business cycles and stages for the economy is a great, great thing. And I always enjoy hanging out with you. It was great hanging out with you again today, Tony. Good show, listeners. That does it for today's episode of The Road to Retirement with our host, Tony Marlette Jr.
All right. Thank you. Thanks, Tony. Talk to you, everybody. See ya.